Good morning, everybody. Good afternoon, wherever you are in the world. Good evening. I am so honored to be here with Mr. Gregg Foss. First came across this man in Miami this year and was blown away by how much experience he had, how he could see everything just like a clairvoyant, and how articulate he was in really painting the problems that we face today in the world and also the potential solutions we have. So here we are, Mr. Foss. How are you today?
I'm doing very well, James. Thank you very much for having me.
Absolutely honored to have you. And just so the people, my audience know, Gregg here, he's got 32 plus years in high yield credit trading, analysis, you name it. I called him a bond trader extraordinaire, played in the high risk area of junk bonds for a long time, has a very clear grasp of macro and financial markets. He's a Cornell grad. I'm a Wharton grad. So it's like first time I've ever interviewed a Cornell grad here. So I love your credentials. Let me see. What just happened? I think I just lost Gregg. Whoops. So we are live TV. So hopefully he'll come back in a second. And well, I'll continue to introduce Gregg, and hopefully he'll be back in a second. Interview on. So, internet problems happen, everybody. Anyway, back to Gregg. He understands markets. He has an extremely articulate way of... There he is. Okay. Let me see. Gregg, are you back? It's always the problem with live TV, everybody, but it proves it's real. So it should be here any second. Anyway, we first met in Miami at the Bitcoin conference, and I've just been blown away ever since. So we're just waiting for him to come on. Now, there he is.
I'm sorry, I'm not sure what happened on my end, James.
No problem. It's live TV. It proves to the audience you are real. It's not staged.
Okay, so I'll tell you where I jumped off. You were a Wharton grad, which I that's awesome, man. I didn't know that. So cool.
Yeah. No, awesome. I was just giving you your background. You know, you're more than 30 years, kind of like me. Yeah. You're a high yield credit trading experience, your macro knowledge of the world, your understanding of how financial markets work, et cetera, and you know, you come from the financial risk management background, as do I, and we have just so much to talk about. But before we jump in, I'm going to talk about kind of the channel and more of the parallels between us. And we've got a lot of ground to cover, and we'll pack more information here than any other Foss interview ever. I'm confident of that, but we're going to have to move fast. So this channel's about math, money, and freedom. I too am retired, but I've never been busier. You have an engineering background, and I have a thesis that it's easier for engineers and people with mathematical backgrounds to wrap their heads around Bitcoin than it is for others, like people like Saylor and CTO Larson and all the people I've spoken to before. You started in engineering, and then you moved to finance. Can you tell us, do you agree with that thesis that you need to understand math and engineering for the penny to drop for Bitcoin?
Okay, I agree that it's easier for us to get it, but I don't think you need to absolutely be an engineer or, you know, mathematics helps everybody. Math is the base layer of language, right? So let's not mess around. If you don't understand the base layer of language, and by that I mean, you know, you can speak Chinese or English or French, but at the end of the day, that's your second layer language. Your base layer is math. So yeah, I am an engineer. Principles like the rule of conservation of energy, first law of thermodynamics are very important to me. And then what engineers learn to do, I think, is think in a first principles basis. And that helped me out. I knew very quickly I didn't want to be an engineer, practicing engineer, but essentially I became a financial engineer and a risk manager trading on the floor, being able to, you know, do fractions in your head and probability analysis in your head is key to survival. So I appreciate you saying I was a risk manager extraordinaire. I'm not sure I was extraordinaire, but what I never did was blow up. And the key to not blowing up is to reversing your decisions when you realize you're wrong. And everybody makes plenty of mistakes. The thing I love about Saylor is when he first saw Bitcoin in 2013, he believed it was a Ponzi scheme. So, you know, there's credit to a gentleman who's done his work. There's plenty of other people out there that don't ever change their position, and whatever, as the facts change, and they end up getting carted off the trading floor, right?
That's true. In fact, I always talk about the importance of personality type, psychology, suppressing that lizard brain to be able to admit you're wrong. And that's a huge issue for people today. Like I still come across people, they're married to things like, I won't even mention the names of the tokens or the stocks, but they've gone nowhere for 4 years, but they're waiting in hope. They don't want to sell because they don't want to admit they're wrong when they're underwater. Have you come across that with people? Like you mentioned, you've got no problem admitting you made a mistake.
It's the first, it's traders, the best traders you ever see are those who cut their losses quickly. They sell their losers. Human nature is to sell your winners, right? You want to crystallize a capital gain, and you hold on to your losers in the hope that they return back to the price you paid for them. You will never survive as a trader in that environment. You need to cut your losers. You need to add to your winners. Okay, that's very key as well. If you're on the right side of a trade and it's going in your direction and you still think it's cheap, don't be afraid to add more of it at a price that's higher than you initially paid, because your thesis is playing out.
Awesome. That's so good. So let's talk before we get into the whole bond market and Bitcoin and everything else. I want to lay the ground around today's inflation rate. Obviously, in simple terms, some people don't really understand how financial markets work, but I always try and simplify things. So today's inflation rate is far outpacing interest rates, meaning borrowing has a negative cost. Now, in other words, if you look around the world, say, for example, the US, your real benefit from borrowing fiat and paying a low interest rate is about 5.95% based on the CPI from last month. In the UK, I think it's about -3%. In Germany, it's about -4.6%, etc. So what do you feel like? How sustainable is this medium term?
Well, so there's a couple of things there. That's a great question, but it's a bit loaded, okay? Because you're assuming firstly that the CPI basket or the index itself is actually being properly calculated. That basket gets changed on a regular basis. And I'd like to point out that if you calculated CPI using the original formula in 1980, when CPI first was calculated, annualized inflation is actually over 14%. Okay. So right now, even using their posted number of 6.2%, yeah, you're absolutely correct. You take a nominal yield on the US 10-year for a number of 1.5%, and you subtract the inflation rate of the posted inflation rate of 6%, and you're at negative 4.5%. That's based on a number that I believe grossly understates the true inflation. Imagine starting with an inflation rate of 14% and realizing how negative your return is if you own a nominal yielding bond of, 1.5% in the case of US 10-year treasuries, and actually 4.25% in the case of US high yield bonds. So I did trade junk bonds my entire life. Credit, I start I start every analysis with a credit viewpoint. High yield bonds have never been a worse risk return opportunity in my entire life, not just on a real basis, again, after subtracting inflation, but also on a nominal basis. People are earning 4.25%, and you're not even accounting for your expected and unexpected default losses out of that. Okay, defaults are a cost of investing in high yield bonds. Imagine if those default costs are run 2% annually. Well, you're at 4.25 minus 2%, so you're actually at 2.25. You subtract management fees, you're under 2% before inflation. I don't know what people are doing, but you shouldn't own high yield bonds here, people. That is the absolute worst asset category to own within the fixed income universe.
Yeah, let me double click into that. So what are bond traders doing now if inflation is crushing bond yields? How does this impact, in your opinion, other asset markets if bonds are seen as unfavorable?
Well, yeah, so they what's happened here, let's be honest, James, is most bond managers have lived a 40-year bull market in bonds. Because when I started trading in 1984, I was trading my personal portfolio in 1984, but I was trading as an investment manager, a risk manager in 1988. 1984, US 10-year treasury yields were over 14%. Okay. And we've just gone from 14% all the way down to almost zero. or, some blips and bumps in between. But when interest rates go down, as you know, bond prices go up. But there's no true capital gains in bond prices because a bond is only a fiat contract. It's a contract to receive a fixed coupon. And if you pull forward the higher coupons, because they were initially issued when inflation was high and interest rates were high, you pull them forward in a higher price, you cash out that price. And if you have to reinvest them, the new coupons you're getting are lower. It's nothing, all this stuff about, I'm a bond trader and I've made all these capital gains. No, there's no true capital gains in bonds. You're just crystallizing a higher coupon bond in the form of a higher price at present value. So, what is the truth? Right now, the return, assuming no default of the US Treasury, which is not a zero probability event, by the way, but assuming no default of the US Treasury, the return in the next 10 years, whether you trade the US 10-year Treasury or you buy it and hold it to maturity, will be exactly what the yield is today. That's 1.5%, which means if you have a 60-40 portfolio mix, much like a lot of the big pension managers out there, your bond portion, the 40%, is only yielding, if we're talking treasuries as a benchmark, 1.5%, which means what do you need to make on the other 60% being equities in order for you to reach your bogey of, let's say, 7%, which is the case of CalPERS, okay?
Yep.
They need to make 7% with a 60-40 mix of which, again, to keep the math easy, 40% of it is earning 1.5%. So let's say it's earning 2%. So what's 40% of 2%? That's 80 basis points, which means the other 60% needs to make up the difference, or 6.2%. What's 60% divided by, or 6.2% divided by 60%? You need to earn 10% annualized on equities forever and ever when you have a 60-40 mix of equities and bonds. And by the way, equities are not a contractual return. Yeah, they can certainly have extremely good performance years, but some years they really don't do so well, right? So that's what's impacting the whole asset allocation space. These investment guidelines that are set up and take a lot of time to change, the bond allocation portion of these are broken. And you need the pension allocators and the administrators to change their tune.
Where would
it doesn't work.
Yeah, I've seen some, like what I deem, like we don't give financial advice here, but what I deem almost criminal behavior. And there's big names, big money manager names. I've seen people with 7-digit portfolios professionally managed by groups like Vanguard, where they still have these portfolios in that 60-40 mix.
Yeah.
And then you mentioned CalPERS. It sounds like they're still doing the 60-40. How long is this sustainable?
So this is financial advice. I know you don't give financial advice. Do not listen to an asset allocator that tells you have to stick to the 60-40 bond or equity bond. Bonds are not a safe investment right now. Okay. They are absolutely not. It's actually the worst risk reward opportunity I've ever seen in the history of bonds. I mentioned high yield bonds in particular, but the same thing applies to US Treasuries. They are being suppressed by the Federal Reserve buying $120 billion a month of these securities. And it's like trying to hold a beach ball under the water. The yields, they're trying to hold a beach ball. And as soon as they lose control of that beach ball and yields spike, you can see bonds drop by 25 points. 25 points on $100 is it's 25% capital loss on your bonds. That's not safe, okay?
Yeah.
But for the last 40 years, nobody has considered or had to live those realities. So, how do these change, James? I guess you teach people mathematics. You will hopefully, the old guys, go out to pasture. I'm not saying I hope they disappear, but I hope they go out to pasture, and the younger asset allocators get a hold of these pension guidelines. It's absolutely, you called it criminal. I think it borders on that.
I said borderline criminal, not criminal.
Okay, I don't want to. Okay, good. How about we call it then conflicted advice and something like the theory of agents? Okay, I'm going to keep doing it as long as CalPERS keeps doing it, as long as Vanguard keeps doing it, as long as CPPIB, which is Canada's largest pension plan, keeps doing it as well. It's very dangerous. Bonds are not a safe investment right now, particularly once you include the inflation, the potential for longer term inflation implications.
So how do you wrap your head around this? There was a very interesting mathematical result from Seyfedin, and he said the average debasement for fiat currencies around the world over the last 30 years is about 14.1%. The average return for the S&P 500 is about 14.3% or something like that. I could be wrong by 0.1, 0.2%. But, and then I was saying since the beginning of the year, since the money printing happened, triggered by C19 in April 2020, you know, that 40% that trickles into the economy, I knew 15% was coming. And I've been talking about that since January of this year when I started the channel. So everything is coalescing around this 15% debasement, 15% hurdle rate for the stock market, 15% inflation. What do you think about all this? Is it just a coincidence, or is it actually manufactured? Is it engineered to be mathematically this way?
Wow. Yes is the answer, that it's engineered to be that way. Is it a coincidence? No, we have to play probabilities here. The probability is it's not a coincidence, but I don't think the correlation is 1-to-1. Okay. What's really happened, okay, is, as Preston Pish says, and all my friends in the know in the financial markets, the yields, the suppression of 10-year yields has caused discount rates to be artificially suppressed, which therefore increases cash flow and net present value analysis in the stock market. Well, the two can be correlated in that basis, because why? Well, because you print money, printing money QE depresses interest rates, and therefore discount rates being low increases growth stocks and equity returns. So yeah, you can draw that. That's circular in that respect. The fact that they're all 15, 15, and 15, not going to say it's 100% probability, but likely it's it's a neat starting point for sure.
Awesome. Now I'm going to switch gears and talk about, you mentioned some people like Michael Saylor, I'm a big fan of his, and Preston Pish, etc. Safety. Cathie Wood. So Cathie Wood is an interesting lady. I'm a huge fan of hers. We don't necessarily agree on everything all the time, but she suggests that Bitcoin may take on some of the function of bonds in the very near term. What do you think about that?
Full disclosure, I've met Cathie Wood a number of times. She actually I invested alongside her, let's be honest, in a fund that brought Canada's first Bitcoin ETF closed-end Bitcoin fund to the Toronto Stock Exchange. Oh. Yes, I believe that she's one of the best asset allocators on Wall Street. I also believe that her focus is mostly on equities, and that perhaps her understanding of the bond market is not quite as sharp as her understanding of the equity markets. In that, what is a fixed income security? We need to be really careful what defines a fixed income security. It is a contract with a fixed coupon. Bitcoin is not that. Bitcoin is much more like a store of value that can be construed as, I like to think of it as digital energy. You might think of it as a battery. You might think of it as storing the value of your time and energy over time, the value of your work and energy over time and space. But it's not a contract. Fixed income or bonds, hence the word fixed, is the contract. And a fiat contract has your coupon return and then your principal return. And what people tend to forget is, if you lend someone money, $100 at time zero, and it's due in 10 years, and they make good on that contract, the purchasing power of the $100 that you get back after you lent it to them at time zero, no one takes that into account. That is like a 65% loss of purchasing power. And Bitcoin could help you on that side, and that could be where Cathie's coming from. So it's a hedge to the fixed income conundrum, but I don't believe it would replace the bond allocation.
Great. And sticking with Cathie for a second, because inflation for me has been as clear as day. I know, again, mathematically, there's a direct correlation between money printing and inflation. There's no ifs, ands, or buts.
Yes, sir.
Joe Biden came out and said, our infrastructure bill is actually going to cure inflation. I've never heard such crap in all my life. With all due respect to our president, I thought that was kind of like, what did I just hear? But Cathie Woods is very big on deflation. Now, I understand technology is bringing about deflation, but that is only for select items like EVs or flat panel TVs, etc. What's your take on deflation? Do you think it will be a thing?
Again, yes, I do agree with Cathie Wood that the impacts of technology are deflationary. One of my good friends, a fellow Canadian, Jeff Booth, who you may or may not know, but he wrote the best book that I've ever read. Okay, I pitch it a lot, but yeah, it is the best book I've ever read, called The Price of Tomorrow.
Yep.
I believe there are deflationary impacts over time underlying, but you need to get through this scenario first. Our supply chains are backing up. Intermediate PPI, which is a very big component of the next CPI that's coming out, is running at 27%. Okay, CPI is not going down in the next few reports, and I don't care what anyone says. Even if you believe 6.2 was the number, the producer prices, which will flow into CPI, ensure that we're going to get a couple of more 6% handle CPI prints, okay?
Yep.
Maybe over time, and maybe over the period of a 30-year long bond, you'll get some deflationary impacts, but let's not overthink this, all right? Currency is still debasing. That is 100% certain. So I don't care if it's an inflationary environment or a deflationary environment, you will get your money back and you will lose purchasing power. And the longer you lend to somebody, the more purchasing power you lose, because it's the debasing of the currency that is a certainty. They need to keep printing the currency because the debt balloon is expanding, and there is the math.
Yeah.
It is 100% certain under any scenario, inflation or deflation, that the debt balloon expands. Therefore, you're entering into a contract in which you are repaid in a debased, or I'll call it a return of capital that you're not taking all the costs into it. You called it, right? You said there's a negative cost to borrowing. Well, what does that mean then? There's a negative return to lending, okay? There's a negative return to lending.
It's so funny because people have a hard time sometimes inverting things in life. I don't know if it's because the brain is designed just to move forward but not think of things backwards. But once you can flip things around, everything becomes very clear. Speaking of that, I do remember once you said, double clicking into what you just said, debt is now, 4 times global GDP? And if you assume a 3% interest, that's equal to 12%. That means the global economy needs to grow at least 12%, or else we keep digging that hole and having to print the money.
You're absolutely right.
Has that even gone up to 15%?
I would argue that yes, the likelihood of increased coupons means that the debt balloon, just because people will price over time the need to compensate at least a bit for this inflation, then that coupon has moved from 3% to probably, let's even say it moves to 4%. Then it goes up to 16%. Even a 100 basis point increase in the coupon means that your GDP needs to grow at 16% annualized. And this is global GDP. This is not just some small country that knocks this is the whole world, the sales or the revenue line of the whole world.
Exactly. So you seem to be very well plugged in, and I know you're very well plugged into what's going on. So institutions are smart. We both know that. And they know what's coming. The question I have for you is, what type of conversations are they having behind closed doors right now? How are they preparing?
Well, let's cut that down. Some institutions are smart. There is so much dumb money out there, James. Like, there really is. I've never. It continues to astound me how much dumb money there is in the world. And as the governments print more money and give it to people who have never managed money before, that money becomes even more dumb. Like, let's talk about something really dumb. RIVIAN Motors, or whatever that is.
I was just going to say that.
Yeah. Okay, look, it trades at over $120 billion.
Yeah.
Now, people, please do you not understand what 120 billion is? That's the value of Boeing. And Boeing produces aircraft and produces cash flow and has a 20-year history of producing machines that fly and transport people.
And 60% of Boeing revenue comes from the government. It's military. People think it's just commercial planes. It's way beyond
so let's not get too granular here.
Yeah.
Look, I'm not telling you, this is not financial advice, but there's certain things you should own and certain things you should short. And we flip trades on its ear all the time. You know, if it's good enough to sell, it's good enough to short. Well, you know, there's lots of trades you can look at. I just don't believe people understand how capital markets work. Things like enterprise value versus market cap are lost on a lot of people, and including a lot of equity fund managers, to be honest. Okay, James, you said they're smart. They're not that smart. There was a time in Canada where institutional equity managers would not buy the debt of the world's largest high yield issuer, called Rogers Communications. It wasn't the largest in Canada. It happened to be the largest high yield issuer in the world.
Wow.
Okay. At over $4 billion of outstanding high yield debt. And all the equity was traded in Canada and owned by the equity managers who were trying to match the Toronto Stock Exchange TSX 60. Okay. Their index, their bogey. I once called up a guy who owned $900 million of Rogers Communications common stock and said, we're bringing a high yield debt issue for Rogers Communications in Canadian dollars. I'd like to sell you some. He said, I'm not buying any. And I go, what? He goes, it's a junk bond. I say, yes, it is, sir. And you own $900 million of the subordinate claim, meaning you own super junk equity. Pejoratives aside, you own a subordinate claim to the bonds. If the bonds are not worth 100 cents on the dollar, your $900 million of equity is worth zero. Zero. How much can I put you in for? None. Okay, now, this is the same investment policy committees that make decisions. Yeah. Why? Because the investment policy committee would not allow me to own a junk bond. Well, that doesn't make sense to me, so let's play a game. At what price would you buy this? Meaning, you didn't like the 10% coupon. Would you buy it at a 15% coupon? And again, they continue to say, I will not buy it at any price. At which point, now I'm the trader, then there's a salesperson on the other side of the desk, and he's got, hot button. He's like, this is my account, Foss. And I go, you are the stupidest asset manager I've ever met in my life. The salesman's like, Foss, get off the phone. You're polluting my relationship with this guy. So look, that's an example of an absolutely asinine investment policy guideline of which these guys are still managing money and likely have 40% of their capital invested in bonds because that's what pension funds want,
It's so beautiful. Let's flip this around and double click. A simple trade, okay? I love arbitrage. I love pairs, etc.
Okay.
What would your approach be? Imagine I'm a family office. I have $100 million I want to get some alpha on. Would you recommend buying GBTC and shorting BITO or one of those other ETF futures for a family office?
Okay, so let's play an even bigger game. I manage CPPIB, the Canadian Pension Fund Investment Board, Canada's largest pension fund. They know they need.
It's like a Canadian CalPERS. Is that like a Canadian CalPERS?
It's even bigger because it's for the Fed. It's for the whole country, not just for a province or a state. Okay.
Yeah.
And it's 10 times bigger on a relative basis. It's 10 times bigger than CalPERS is, in Canada. So it's the biggest one in Canada. They know they need Bitcoin. Okay, so I finally have some brains at CPPIB and I say, I need my allocation to Bitcoin. Why don't I buy it at a 15% discount to net asset value, i.e. GBTC? And I wade into the market in big size, but not, I don't go bid for $10 billion right away because GBTC is a $40 billion fund, right? And let's say CPPIB needs $40 billion of Bitcoin exposure to move the needle so that they get 3% allocation to Bitcoin. Damn, I would love to have that trade in my hip pocket because whether or not I'm shorting BITO against it, which could be a cool hedge to keep the price down of the GBTC you're trying to buy, if Canada succeeded in getting the 10 billion or 10% ownership without disturbing the market, they would at least take the 15% discount out. They would make $1.5 billion just on the first trade, and then they go issue bid for the other 30 billion of GBTC I need. Wow, how cool would that be? And what do they accomplish? They get all of GBTC, then they unwind it, and they say, thank you very much, I don't need Grayscale anymore. I'll just take the Bitcoin, and now it's on my books. How cool would that be?
That's awesome. And in fact, thinking of you talking about kind of government and pension money and everything else, I'm going to throw you another curveball. If you were in charge of the Canadian government or the Fed or anything else, what would you do to fix the money problem?
Very simply, I would embrace Bitcoin as my savings account and work to endorse and secure the network on Western soil. China has served up the West an absolute gift here.
Yep.
I would work to secure the network. I'd start accumulating for central banks in the West Bitcoin and use that as a store of value where you eventually will have Bitcoin as world reserve asset, supplanting US treasuries. I would furthermore continue to endorse US dollars as being global reserve currency. Global reserve currency is your checking account. Bitcoin reserve asset is your savings account. And the two mesh and work beautifully. International trade with your checking account, store of value, sound money principles with your savings account.
That's
perfect. Parallel system. It's a parallel system.
Because I ran the numbers, assuming a very conservative 10-year compound annual growth rate of 30%, 33% Bitcoin appreciation, you only need a 1 to 3% allocation to hedge your fiat.
Anybody does. How about if you're a central bank, though, and you actually want to be able to have a reserve asset and have an allocation or an ownership of that reserve asset that allows you to maintain your dominance in economics, allows you to maintain your dominance in security and homeland security. There's a very smart young man by the name of Jason Lowery. I'm not sure if you follow him, but he actually works for the US Space Force, and he's developing a thesis as to how Bitcoin can actually prevent the next
yes, I read about him. He came out about 6 months ago.
Yeah, he did. I've had dinner with him in Boston. He's the real deal. The guy is a global thinker. He's also a rocket scientist. Isn't that interesting, right? Another rocket scientist that gets Bitcoin. Yeah. But here's the reality of this. Again, you need to understand the gift that China has provided to the West, and I think it would be a shame if we fumbled the gift that China has provided. So there are some politicians on both sides of the border. I'll just tell you, I had a very good call with 45 members of parliament in Canada on the subject of Bitcoin. When you have natural resource energy like Canada does, you can use to mine Bitcoin.
It's so funny.
Mine Bitcoin at a price that is very competitive with global energy prices. Man, oh man, you're supposed to take advantage of that.
It's so funny. About 3 months ago, somebody who is the chief of staff for a mayor of a town or a small area in a province in Canada, I will not release the name.
Okay.
The population is, I think, 50,000 people. They have unlimited hydroelectric power. And they asked me, hey, can you make a video to convince my mayor in my town that we embrace Bitcoin mining? So I did that. And now that's been watched by politicians in countries all over the world that have an abundance of cheap energy. So that I've got to share that with you after this.
I would definitely look forward to seeing that. I will say this, James. Bitcoin is digital energy, and Bitcoin miners that don't control their sources of energy are at a disadvantage to those that do. Yeah. Okay. If you have an abundance of natural gas that can be burned and run through a generator to create electricity, and by the way, you can do it with an ESG,
like flare gas.
flare gas. But here's a better one. You take a turbine and you do combined cycle where the exhaust of the turbine then runs a steam generating, and the combined cycle could be included in a geothermal application to cool the system, and it's just so engineeringly beautiful, these solutions. And what you need is a real visionary. Ultimately, and Canada's good at this, our nuclear energy and our nuclear understanding and knowledge in Canada's, we bat above our weight. And if we can get this small modular reactors that run, literally, 300 megawatts, this is exciting.
That's what Bill Gates is doing. Yeah, Bill Gates is investing heavily in that space right now.
In the nuclear energy? Okay.
Modular reactors, yeah.
Nuclear, though, small modular nuclear reactors. Yes, interesting. I'm not a huge fan of Mr. Gates lately, so if he's actually doing something smart for a change, that would make me happy. But at the end of the day, look, this is about Canada having an opportunity to really lead the world, and also states like Wyoming that's doing it already. But what you need is the big ass states to do it as well. The New Yorks and the Californias. Energy is every single advancement in human productivity is accompanied by an advancement in energy technology.
Correct. Yep.
Bitcoin allows advancements in energy technology that are otherwise not possible because they're not economical. Bitcoin makes various sources of energy economical. And that is why I'm so excited about this, and why I'm involved in a power company in Canada that does exactly that.
That's super exciting. You got me now thinking about energy and more geopolitical energy war games. So as you know, Russia, Middle East, China, they don't like the idea of the US being the reserve currency or the petrodollar. You got Russia selling natural energy for Ishcoin, you could say. I think you may have even said that exact thing before. So please, I talk about the PetroBitcoin or Bitcoin Petro, whatever you want to call it, as a replacement to the petrodollar. Please discuss with us, because you seem to be very plugged into the whole energy world and the fact that digital energy is Bitcoin, stranded energy, etc. But do you know of a pathway for Bitcoin to replace the US dollar in the petrodollar system? Now, like people talk about, a spot ETF will be huge for Bitcoin, but a Bitcoin petrodollar, somebody said, hold my beer.
Way bigger. Hold my beer. It's over. Okay. Yeah. And all it really takes is one of the non-OPEC nations. Think. Who could that be?
Qatar.
Would his name start with O? Would his name start with Vladimir? Okay, let's stop. Let's just say that Vlad doesn't want to get fiat dollars for his valuable natural resource energy. And he just decides, I'm going to start pricing my oil and natural gas in Bitcoin. For me as an engineer, it's totally logical. And I understand the reason the petrodollar exists. I actually don't believe the petrodollar is, there's a lot of problems with the petrodollar. Saudi Arabia won't embrace pricing Bitcoin or their oil in Bitcoin because then they lose their petrodollar protection. We all know why the petrodollar exists, but let's just be honest. There's a lot of oil producing nations that could veer off of that US dollar pricing standard, and it would make sense from an engineering perspective. Why sell valuable natural resource energy for a worthless paper dollar or a worthless fiat contract not backed by your paper dollars, but priced in your paper dollars? Bitcoin is the perfect closed loop solution for the rule of conservation of energy.
Yeah. And that's, if you look at what happened in Europe, natural gas prices have gone through the roof because Russia decided to sell all the natural gas to guess who? China. And they need it. They don't have enough juice to run the whole system. And that's causing massive inflationary pressures throughout Europe. And, the cost now to heat family homes and everything this winter it was very high to begin with, but now it's extraordinary. So it is a super interesting concept. So let's switch gears now. Let's go back to, actually, speaking of China, What do you think about Evergrande and the next shoe to drop, and what impact could that have on bond market?
Yeah, great question. So look, bonds are, I need to describe what a bond manager is. Okay, a bond manager starts every analysis with how much can I lose?
Yeah.
Whereas an equity manager starts every analysis with how much can I make, right? Bonds by their very nature are asymmetric to the downside. You pay $100 for a bond, the typical bond contract, $100 or $1,000, it doesn't go to $2,000, okay? Whereas you buy $100 equity, it could easily go to 200, it could go to 2,000. Bonds can go from 100 to 0 because the bonds default and you get a 0 return on the restructured product. But they never go from 100 to 200. And so bond managers are pessimists and equity managers are optimists, okay? That's just the nature of it. But the most important thing to understand is bond managers run the world, okay? The bond markets are way bigger than the equity markets. Bonds have a priority of claim over equities. Therefore, in my previous job, I own too much of a bond, a high yield bond that I think is prone to default, and the price of that bond is falling. I can run out and hedge it if it's a publicly traded company by buying put options on the stock or shorting the stock outright and doing what's called a delta hedge, and trading a recovery rate. But that's what capital structure arbitrage is. You're using your priority of claim advantage to the detriment of the equity. So let's talk about Evergrande. First of all, anyone who looks right now at the price of Evergrande stock is an idiot, okay? They absolutely don't understand priority of claim because the bonds are trading in the 20s. Yeah. And when bonds are trading in the 20s, they're trading there not because someone thinks they'll ever go from 20 back to 100. They're trading there because someone thinks they'll get a recovery rate on default from 20 to, let's say, 35 cents on the dollar. That's almost 100% return on your 20% in your $20 investment, but it is not going back to $100 with any degree of likelihood. Could there be a 1% chance it goes back to $100 or parity? Yeah. But really, what is the new capital structure in Evergrande? The bonds have become the equity. The equity is now a way out of the money option, but you got stupid people buying the equities because the equities trade on an exchange and there's disclosure. Oh, and by the way, I'm an equity guy, and equities can grow to the moon. Well, any equity analyst of any company that ever invests in a stock without knowing where the bonds trade, come on, guys. Like, please. But this happens all the time on Wall Street and Bay Street. How do I know? Because I've worked there. And I get equity analysts all the time running to me when things start hitting the fan, and they can't understand why their equity is getting slaughtered. And I'm sitting there, well, one of the reasons it's getting slaughtered is because me and all the other bond guys are out there shorting the equity to your idiot buyers because our bonds may not be worth 100 cents on the dollar. Evergrande is a bad situation. It's in a high yield market in China. That is not really a high yield market. It's a property developer market. All the high yield issuers are property developers. They all have the same systemic risk. They are all going to default. Very simply, if you're playing the game that China is going to rescue Evergrande, you're playing a fool's game. I'm not saying it's not going to happen, but that's not how you trade those types of names. Any spreads don't make any sense. Okay, I need to stress that with you. When I say spreads, the bond spreads are now for kids. It's all a price basis. They're buying it like an equity. If it trades at 25 cents on the dollar, they're hoping to get 40 back on a recovery.
Wow.
It's not a fixed income instrument anymore. It is now the equity of a restructured company. So what are the big risks? The big risks are there's contagion in the market, and the high yield market in China gets destroyed, which it's getting destroyed, but that flows into the investment grade or higher quality corporate market in China. And then that flows into the default potential of China as a country. And you can monitor all this in the credit default swap market for sovereign credits. And you'll see that China ain't doing so good in that market.
Yep.
Meaning people are purchasing insurance to hedge against the potential default of China. So let's play this forward a little bit. China is the second largest economy in the world. And if they can't refinance their debt because people are concerned about the potential for default, what do you think that does to global growth? Like, I don't even want to think of it, okay, James? I just don't even want to think of it, but it's a non-zero probability that that could happen. And that's why you have, oh, go ahead.
So could there be, like 2022, a little bit of contagion then from what you just said?
Not just a little bit, okay? Not just a little bit.
I don't want to alarm the audience too much.
No, I don't want to, but look, I lived through Lehman Brothers, right? Oh, the housing crisis is contained. Who said that? Alan Greenspan, circa 2006. We think subprime mortgages are nothing more than a blip on the radar, nothing to be concerned about. 3 years later, the world was almost destroyed because of the leverage unwind that took place in the system. I'll tell you, I've never been so scared in my life as sitting in a risk chair in March of 2009, when day to day, you were almost sure that it was not going to last one more day. There was no bid for anything. Markets were disorderly. It was panic everywhere. Leverage unwind left, right, and center. People have no clue how close we came. Well, I sat in that chair. And by the way, I sat in that chair from a position of strength. We had positive returns all throughout that crisis. And I still felt horrible, sick to my stomach, because we were very close to the whole system going over the edge.
Yeah. Do you think there'll ever come a time where, say, Bitcoin would become that flight to safety decoupling? So imagine contagion
That's
happened.
My whole thesis.
Yeah. Okay.
Bitcoin is a long volatility exposure. You know this. You'll understand this. Bitcoin is the equivalent of being short credit or short sovereign credit risk. When you are short credit, you are long volatility. What are other long volatility assets out there? U.S. Treasuries, when they have the ability to go from 5% yields down to 2% yields, there's a flight to safety. When everyone else in the world is unraveling, everyone wants to own U.S. Treasuries. It's a long volatility instrument, provided there's actually some VIG left in the coupon. But when the coupon goes close to zero, there's no VIG left. And if you want to run to something that has, it's got a floor on it, be my guest. But Bitcoin is the perfect long volatility asset to hedge against all your other assets, which are typically short volatility exposure. Equities are short volatility exposure. Being long credit instruments is being short volatility. Selling covered calls is short volatility. That is a beautiful strategy until it doesn't work. And when doesn't it work is when vol explodes, okay? All of these things are models. They all work real nice, provided the system functions well. But what happens when vol kicks from 15%? What did vol do in 2020 with COVID-19? Vol went from 15% to 85%. Well, if you're short something at 15% and it goes to 85, or if you're short something at 15 and it goes to 85, how's your day going? How's your day going? You better own some insurance against that happening, or you better be long another asset that'll go up in price along with the volatility. And in my opinion, that's Bitcoin.
And tied into that, before I jump into the future, Bitcoin's future as a piece of all the asset classes and how much they're all worth, do you believe in the stock to flow model? And do you believe
I use it? I use it as an input into my calculation. I don't have 100% confidence in it. That being said, I don't even have 100% confidence in my own model. Like, I play a game of probabilities, and I want to walk through that probability game with you when the time is right. Versus what's the probability the market's giving me of my scenario unfolding versus what I think the correct probability of my scenario unfolding should be.
I love that. Yeah.
Stock to flow, it's an input. It's correlated to the performance. Does it mean that it's going to be the one model that overrides all the other models? I don't think so, but I certainly value it. And I think Plan B is a very smart young man, or I think anyway, not to try to dox him or anything. At the end of the day, it's like everything. You need to take inputs, from a lot of other places to come up with a blended probability of your outcome
and that's
coming to fruition.
And like you, that's what I've been doing my entire life, is what I call EV analysis, Monte Carlo simulations.
You have to manage risk that way. You manage risk that way. That's it. You're very seldom 100% certain about anything in financial markets except this. And this is why I'm so confident about Bitcoin. I'm 100% certain. There is no doubt in my mind that fiat currencies will continue to debase at an accelerated basis, because it's only math. And math doesn't lie. There's no subjectivity to that.
I did some real-time modeling with Robert Breedlove.
Oh, I like that. I like Robert.
I had built a model around exactly how that rapid debasement happens.
Oh, yeah.
Because of money printing. It's just, it's like you describing the beach ball you pushed underwater. Only the more you push it, the more the pressure increases, and the harder it is.
Not just the pressure increases. How about the
size of the bubble?
That the balloon expands because it's got a contractual expansion rate. That contractual expansion rate is called the coupon that you owe on the debt. You'd think that we're reinventing, like we're talking about putting something on Mars here. This is about as simple mathematics as you get in financial markets, right? We're not talking first and second derivatives. We're just talking pure analysis.
Why is it then that 97.5% of the world's population don't get it yet? What would your elevator pitch in 2 sentences or less be to tell somebody they need to have Bitcoin?
They're intellectually lazy. That's it, right? That's
it's an IQ test.
Intellectually, it's an IQ test in risk management. I will admit to you, when I was first introduced to Bitcoin in 2016, after I retired from the hedge fund business, I thought like everyone else, that's a Ponzi. Until I saw it in action on tradeblock.com, and I'm a visual engineer, and I see this blockchain working, and the hash is flying across, and the block rewards, and I'm like, what? And no one controls this? And oh my God, I was in love, and I've continued to research it ever since,
It is. It becomes actually an obsession once the penny drops, and the penny dropped for me in 2017. But then early 2020, it became all hands on deck. I got to get as much of this stuff as I can before everything goes to hell in a handbasket.
Right? Well, because in 2000, so that's an interesting segue. Bitcoin is a better investment on a risk-adjusted basis today at $60,000 than it was when I got involved in it in 2016 at under $1,000 US a coin. And the people say, Foss, how could that possibly be?
Lindy.
And the answer is very simply, the probability of me attaining my price target is much higher today than it was in 2016. Why is that? Because the reaction to COVID-19 absolutely assures that our governments will never be able to escape the debt spiral. It is mathematically impossible to escape the debt spiral.
I love talking to people about EVs. And I always tell people there's always a 1% chance that Bitcoin could go to zero. I think you're a little more generous. You say 5%. But even at a 20, like
let's play a game. I think sorry to interrupt. I can give it a much higher probability that it goes to zero and still come out with an analysis that's ridiculously positive.
Exactly. Even if I run a super conservative CAGR on Bitcoin, say 30%, it's going to 1.6 million by the year 2030. So what are your EVs right now? What would you tell somebody over a beer? Say, well, assume 20% it goes to zero.
So this is so good.
And 20% it goes to $1 million.
Let's make sure we define what EV is, because when you just said EV, I was thinking enterprise value, not expected value. So when you say EV these days, some people think electric vehicles. Some people think enterprise value. Much fewer people think expected values. Yeah. Okay, we're talking expected values for EV.
Correct.
Let's play a game. Okay, my price target on Bitcoin in today's dollars is $2 million US per coin. In today's dollars, when it gets to 2026 or whatever you said, it's going to be much higher because today's dollars are going to be worth less, meaning Bitcoin's going to be worth more. Okay, but I'm using today's dollars, James. $2 million per Bitcoin in today's dollars.
By when? What time?
It doesn't matter to me. It's in today's dollars. This is what it should be trading at today.
Got
it. And it ain't. So I think it should be trading at $2 million per Bitcoin today. Okay, in today's dollars. I'm not 100% certain about that. But let's play and back out what the market thinks the probability of it being worth $2 million in today's dollars in. We'll do a binary distribution or a binary outcome. One is 0 and one is $2 million. What's the expected value of that when the answer is $60,000 per Bitcoin? It means the market only thinks there's a 3% chance that it's worth $2 million in today's dollars, right? 3% times 2 million is 60,000. 60,000 is the trading price. 97% times 0 is 0. You add the two together, that's your expected value. Well, I'll tell you one thing, sir. I think the 3% is about as stupid low as I've ever heard. And my probability, while it's not 100%, it's way higher than 3%. It's like going to a racetrack and having watched a pony train when other people haven't watched the same pony. And the racetrack is laying 100 to 1 odds against your pony winning. And you're like, guys, you have no idea. I've watched this pony race against all the other horses in this race, and his chances of winning are at least 25% or not higher. So what do you do if they're laying 100 to 1 odds? I'll go to the window and I'll buy some of that 100 to 1 odds, sir. And if you actually have table stakes, meaning you can impact the outcome of the whole racetrack until it gets to your 25% probability of your horse winning, you keep buying it, right? And then the odds makers are like, Jesus, who's this guy that's come into the track and laying these odds? Look, recoil to Bitcoin. The market right now is only saying there's a 3% chance that it gets to my price target. And by the way, it's a target. It's not a limit. So all you crazy guys out there saying Foss is a bear, I promise you it has to get through 2 million before it gets to your price targets of over that. So let's start with my price target. 2 million. Market's giving me a 3% chance, and I'm throwing this out there. I think it's at least a 40% chance it gets to my price target, which means, in other words, it should be trading, in my world, at 800,000 a Bitcoin today.
Exactly.
What does Greg Foss do when something's trading at 60,000? And it should, in my opinion, it's only my opinion, I buy it with my eyes closed. I just say, okay, sold to me, sold to me. Now imagine if I was one of the biggest asset allocators in the world. I promise you, the price would be much closer to $800,000 a Bitcoin until I got my allocation percentage of, that's what we can decide as well. Should it be X percent of your portfolio? Well, imagine if CPPIB decided it should be 10% of their portfolio and they had to buy, to make the math easy, let's say it's $1 trillion fund. It's not, but 10% of $1 trillion is 100 billion. What would the price of Bitcoin do if you had $100 billion order in your back pocket? Woo, I've seen those types of orders. I've had those types of orders. So you don't tell the world you have that order, but you just go out and you find sellers. And the guy says, you say, I'm a good size buyer. And the guy says, I'm a good size seller. And then the guy pulls down his pants. He says, I'd like to sell 100, I'd like to sell 10 million. And you're sold to me. The bid still lives.
Yeah.
He's like, okay, I'm selling another 10. I'm selling another 10. And all of a sudden he realizes your bid ain't going anywhere. Yeah. And he's like, okay, stop selling. Stop selling. And you go around to another knucklehead. Or what likely happens is that guy that just filled you for 50 million runs around and says, Jesus, I just made a horrible trade. And he tries to front run you to get to another seller so he gets his stuff back. Okay. That's the way markets work.
Exactly. And that's why I'm so bullish, because I've run the math. Just like with inflation, look at the impact of money flowing into Bitcoin. You take that 100 billion from that CPIB. I hope I got that right.
Yeah. Yeah.
You take a multiplier, 25x. That's 2.5 trillion. That's 2.5 trillion on top of the 1.2 trillion is the new market cap of Bitcoin, which means the price is going to 3x overnight like that. But the question is, what's stopping people from allocating? Why
it's like anything, James. It's I lived this in Canada. I sort of made mention. Canada never had a high yield market, a developed high yield market before I got involved. All Canadian issuers that needed to borrow fixed high yield bonds went to the US market to do it. And it took a while, and you see things change. You see a guy saying, I get it. I understand the investment thesis for diversifying my portfolio using high yield bonds. And don't forget, this is when high yield bonds actually paid 10 and 11%. Much easier to sell to get people to buy high yield bonds or, a convincing argument when the yield is 10%, not 4%. Anyway, it took about 20 years. Canada has a developed high yield market right now. It's not as deep as the United States, and it doesn't even have a truly distressed debt function, which is a very important function of the high yield market. Nor does China, by the way. That's one other reason that Evergrande, took the stairway up in terms of price and the elevator down. There was no natural bid below it because there's no real distressed debt investors in China. In North America, particularly USA, there's a beautiful group of distressed debt investors. Man, they know their stuff. They know how to operate in a courtroom. They know how to operate in terms of faking out the foolish holders, which are typically long-only guys. Look, it's part of a process. Bitcoin's only been around for 12 years.
Yep.
And by the way, has it really been in the institutional mindset? How long? 3 years, maybe 3 years. It's a process. So that's why it doesn't happen immediately. But the most bullish argument for Bitcoin adoption that I have ever seen, Michael Saylor aside, okay, because he's quite something. He's unbelievable, is a credit hedge fund called Golden Tree. $40 billion credit hedge fund run by probably the smartest credit analyst I've ever met. A manager called Steve Tannenbaum, who I've met personally, and he gets it. And I promise you, when he gets it, other people are going to take note. And it's like Lawrence Lepard, who is a gold fund manager that embraced Bitcoin because it simply is a better race horse in the race. Now, Lawrence has a bunch of clients that will never own Bitcoin outright, but as part of his gold fund mandate, they own X% Bitcoin because he tells them that's the right thing to do. So all these different things, James, are adding up to more demand. Number goes up, makes other people look at the performance. Why is this guy outperforming me? Well, he has an allocation to Bitcoin. Oh, dang, I better get an allocation to Bitcoin. And, that's how it builds. Exactly.
Exactly. So this is fascinating. So, I always call it the asymmetric bet of our lives. It sounds like you believe it is too. I'm sure you got a very big allocation. Do you look at network effect, Metcalfe's law, adoption rates of Bitcoin? When will we get to 1 billion users from the 150, 200 million we have today?
Yeah, I got to be real
tipping point.
I agree. Look, but I got to be real careful with what I know and what I don't know. Let's leave that to Cathie Woods of the world that have studied this stuff their whole lives and whatever, and invest in companies that have done previous technologies that have allowed for these adoption rates and the Lindy effect and whatnot. Yeah. I'm not that. That's not me, okay? I understand sort of what it means. What I am is a risk manager in the financial markets that basically said exactly what you said. Very simply, this is the best asymmetric opportunity that I've seen in 30 plus years of managing risk. And by the way, this is the kicker. Asymmetric investments define careers.
Yeah.
You don't get that much of an opportunity to see these too many times in any trading history, okay? No. I've maybe seen 3 asymmetric opportunities in my lifetime. I missed one. I got one. Now I have Bitcoin, and Bitcoin's better than the other 2 combined, okay? Both of those other ones were asymmetric return opportunities, but Bitcoin is multiples better than either of those other 2 were.
Well, this has been incredible. I have one last question for you, but sure. I do want to do some modeling with you in the future.
Okay.
In 2 ways, too. One of the things that I also model is the actual supply of Bitcoin and how it's actually already deflationary because so many people are, losing their hard drives, sending Bitcoin to the wrong place. Thumb drives not working for getting seed phrases. I am on the receiving end of so much of that all the time, so we can do more EV stuff. Expected value returns.
I love it.
And deflation, and just simulate what would happen if, a couple of pension funds come in beyond what's already happened. But before we go there, I have a question from the audience, and they want to know what are the 3 best resources you use to stay on top of your game in crypto today, beyond talking to very intelligent people, which we know you do already. But the audience would love to hear that from you.
So I need to be clear, right? Look, I'm a Bitcoin maxi. Hopefully I'm not too toxic, but Bitcoin solves my biggest concern with the world, which is fiat money. Okay. And my experience started in 1988 with fiat money when I was working at the largest financial institution in Canada, the Royal Bank of Canada, after I graduated from Cornell. And the Royal Bank of Canada was insolvent. And it was insolvent because of Latin American debt exposure. And I was working directly for the CFO. And God bless his soul, I went to him and I said, Emil, we have a big problem. And he goes, I know, don't tell anybody. And I'm like, wait a minute. I just graduated from a business school. I came back to Canada, and Canada's largest financial institution is bankrupt, yet nobody knows it. And why do people have confidence in depositing their money in this financial institution? Oh, very simply, it's too big to fail. The government will always bail it out, which largely is true. But what does that mean? The government will always print money. I've been searching for the fiat, the solution to the fiat Ponzi, James, for over 30 years, and I finally found it with Bitcoin. But where do I get my day-to-day knowledge? And I don't have a lot. I sort of, I follow guys like Breedlove. You mentioned him. I follow guys like Jeff Booth, okay? I follow what actually is happening in the world, though. El Salvador is absolutely a beautiful test net for the adoption of Bitcoin. And I'm very tight with a group called Avg Return, which is doing the merchant solution in El Salvador. In fact, I spent the last weekend with their CEO, Jose Lemus, in Miami for 3 days. I'm not spilling any trade secrets. They are growing at 3% per day. 3% per day. Annualize that for me, big guy, and then we'll talk about adoptions and we'll see whether you should have exposure to the most beautiful technology I've ever seen. So I guess a roundabout way of answering your question is I listen to people. I also listen to people and I always read research that's counter to my thesis. So like it or not, I have to listen to guys like Peter Schiff, only because you're always supposed to read research that's counter to your thesis because you don't want confirmation bias, right?
Yep.
And maybe one of these days they're going to be right, but they aren't right today. And so my research comes by listening to people that share I share their outlooks. My experience in financial markets is you're rarely 100% certain about anything, except you have to manage the risk accordingly. And then, Bitcoin Twitter is one heck of a resource. And I've met so many great people on there. Not everyone likes me, and I'm good with that because I don't like everyone on there either. Even if we both agree about Bitcoin, there's different ways of handling that conviction. So I just try and always make sure that I listen to people that call me a fool, because one day, someone calling you a fool is going to convince you that you are on the wrong side of a trade and you better get the heck out before the world figures out. Now, I'm not saying that's Bitcoin, but I have been on the bad sides of trades before. And your best sale is your first sale. And then you sell, and assuming you're long, sell and sell and sell. Or if you're short something and your thesis is changed, you buy it, you buy it, you buy it back until you don't have exposure there. So what are some good shorts out there right now? Because this isn't just a conversation about being long Bitcoin. What are some things I'd be short? This is not financial advice, but I'd be short Western Union. Okay? This is not financial advice, but I'd look into the exposure of Visa, and they're charging 8% merchant fees in El Salvador and other lesser developed countries. And I wonder whether that 8% merchant fee can sustain itself in the face of a payment rail using Bitcoin where the fees are essentially zero.
Yeah. Well, you got another one for you. I got another one for you. How about Berkshire Hathaway? They're three of their five biggest holdings, Wells Fargo, Bank of America, American Express. I mean, these are zombie companies. They're not going to be in the same structure in 10 years.
I was in Miami this weekend, and I'm not going to swear on your show, by the way, because I don't want to. I swear too much. But I did call out Charlie Munger as a conflicted old, and you fill in the blank, okay?
Yeah.
He's soggy. He's wet. He is conflicted. Why? Because he owns so many financial institutions that will be disintermediated by Bitcoin. So he called Bitcoin rat poison, and then Warren Buffett called it rat poison squared. And I'll agree with them. It is rat poison, because what's the rat? Fiat currency is the rat, and Bitcoin is the rat poison, okay? Wisen up, people. Charlie Munger and Warren Buffett are conflicted, and it's very, very easy to call out their analysis. That is not good analysis.
But I have a dream. You and I are pretty much the same age. My dream is to be at Charlie Munger's age of 97 and having these conversations with you. That would be
your
fantastic.
Brain is your most important muscle, and I appreciate you inviting me. Yeah. I'll say the same. Look, I don't wish ill. I just have an issue with people that are calling out the most promising technology to reverse global poverty and people at the bottom end of the spectrum, like Steve Hanke, okay? This is conflicted. It's criminal advice. Yes. And quite honestly, you got to call them out. So the Bitcoin Army is a wonderful group, and I really appreciate you having me. I look forward to future discussions with you. It's been a blast.
And final word, I have a name for you. I hope you don't find it offensive. You are the Bitcoin King of Canada. That's your new moniker.
There's better guys than me. Let's say Jeff Booth. Jeff Booth is the Bitcoin King. I'm a pauper or a pleb, but I'm rowing in the same direction as Jeff Booth. And how about Rodolfo from NVK? A Brazilian in Canada that started one of the first cold card wallets in Canada to store Bitcoin. These guys are the real geniuses, and I'm along for the ride because I have 3 kids. Okay, this is for my kids.
It's the insurance.
This is for my kids. Okay. It's not just insurance policy. What it is the future, and we're gonna win this war. Okay, there's a lot of battles, but we're gonna win this war. So thanks again, James. It's been an absolute pleasure, buddy.
You too. Really appreciate the time. Thanks. Sorry for running long. Talk to you soon.
No, I hope I didn't take too much time, but thank you very much. Okay, bud. Okay, thanks again, eh? Bye.